Volatility isn't necessarily bad for markets, and that's what we're seeing for global equity prices rising this week. Good morning and welcome back to Morning Markets here at True Potential. Now, the volatility in equity prices is being driven by the robust outlook for corporate earnings and the fact that the inflation peak is well behind us. Most major equity regions now expect robust earnings growth over the next 12 months. And the peak in the inflation cycle helps that outlook. So whilst markets are in this healthy limbo of high aggregate employment, and that's still increasing both in the US and the UK, for example, and falling price pressures, it really leaves us looking at the outlook for interest rates, particularly in the US, given markets do expect a lot from the FOMC, the committee which sets the policy rates in the US, and whether that is likely to be delivered. For context, markets in the US now expect 1 percentage point of rate cuts this year and another 0.5 percentage points by Easter. So with the policy rate at 5.25, markets expect something close to 4 by the end of the year and something around 3.5 by Easter. That is a lot, and in fact the Federal Reserve have only ever cut interest rates that quickly when trying to counteract a recession. But perhaps this time is different, and that's because current policy rates are way too high for the trajectory of inflation declining. In fact, if inflation was to fall just 0.5% from here, it's likely that interest rates should be around 3%, not 5%, and that's simply using the model set by the Federal Reserve themselves. So, reflecting on this week's data, what is actually the outlook for inflation? We have seen further encouraging trends in both wholesale prices and consumer prices. Following the downside miss in wholesale prices, we know that that feeds through into core measures, and in fact that was delivered yesterday. We saw a further decline in core inflation, such that we can expect US core CPI to be below 3% come the autumn. We also saw another encouraging decline in headline CPI, such that it's now below 3% for the first time since March 2021. So the trend is still our friend here, and we are seeing further declining pressures ahead. This is very encouraging, and the Federal Reserve are likely to acknowledge that in September with their first rate cut. However, there is little for them to be too worried about, such that an interest rate cut of 0.5% will be delivered. What markets will focus on will be the next jobs data from the US in the first week of September, which is still a world away given we're only in the middle of August. And of course, the UK isn't alone here. We've delivered a rate cut last month, and now we've had this morning GDP data for the month of June, which was 0, but that was expected. And that really rounds off a very strong Q2 for the country. And we've obviously also seen declining inflation pressures here. So the Bank of England may dig their heels in at their next meeting and refuse to cut interest rates. However, they're likely to soon follow the US Federal Reserve and cut in step, such that we should see a substantial decline in interest rates going into 2025, particularly over the next 6 months or so. So the trend is still our friend here. Inflation is declining, and it's supporting equity prices, which are already very buoyant from earnings expectations. Thank you very much and take care.